stock market in China. Tom?
Yeah, Anna, really, is this the question, or does this point to now policymakers in Beijing really ramping up finally that support for this beleaguered economy? What really stood out for me was the retail sales number out of that data set, which was just so soft, and just points to the lack of the impetus coming through from the Chinese consumer. And then, of course, the unemployment rate and the fact that they are now no longer going to be publishing the youth unemployment rate, which we know is about 20%. Or do these measures smack of desperation? The cut to the MLF, 15 basis points more than had been expected, and now this cut to stamp duty. We continue, of course, to keep an eye on what is happening and the policy reaction from China and Beijing. The futures new pointing to gains of 0.5%, some very modest upside yesterday in the session in Europe, led by financials and retail. On the downside, energy and basic resources. We'll see how the sector shift changes in the session today, this Tuesday. FTSE futures pointing to gains of around 0.3%. Of course, we're looking to that BOE response and the gilt yield response to that wage data out of the UK. And the DAX futures pointing against 62 points, up 0.4%. Just under an hour away, of course, from the cash equity trading in Europe. And that's a check on the futures. Let's check in on how things are shaping up then ahead of the US trading day as well. Of course, the data point, or at least the statement coming through from the FOMC on Wednesday in terms of those minutes, will be of interest as we see yields again on the 10-year ticking up 420, just about 420 last time I checked. Futures staying side, S&P futures getting 0.2%. We saw a bit of a rally in terms of tech that lifted the Nasdaq around 1% by the end of the session yesterday. Nasdaq futures pointing to further gains today, up 0.3%. Dow Jones futures just up 8 points. What's standing out to you, Mark, on the GMM?
So the GMM today is very interesting because you've got to look at everything through the lens of the immense amount of news flow we're getting out of China. It's policy, it's data, it's news on the problematic property sector, and it is the price action. So let me go through that. First of all, in the equities column, equities are weaker. So we have this balance out of policy support versus data. And they're generally saying this is still not a good picture, especially with the news flow. Otherwise, it was a very quiet session in Asia. And I should point out that overall, this is a market which has not reached a clear conclusion either way on what the overall message is from China today, because there's been so much news flow. The yuan is weaker. That makes sense. The policy support that we got, the MLF cut, should weigh on the yuan, and we're also getting poor data, also should weigh on the yuan. So that makes sense, but it's not massively weaker. However, it is interesting that metals, commodities, are doing much better again today, and metals in particular have bounced back. They did not bounce on the MLF cut. They actually bounced later on in the day after we processed the combination of the MLF cut and then the data. They were down still by the time we went into the poor data. And kind of validating that idea that metals are saying the picture we got out of China today was a positive impulse. Is Australian dollar also much higher? We've just seen pounds jump onto the board because of that data. Again, the Bank of England definitely going to be hiking again because of their wage problem. They have an inflation problem. That is feeding into the theme of higher yields generally. 10-year yields continue to nudge higher. We got really excited when we got about 3.8%. We got really excited about 4%. They keep on going higher. And importantly for yields now, it's real yields too. So you know the backdrop has been softening inflation, and yet yields continue to go higher because we've just got too much supply and a lack of demand. That demand-supply imbalance hasn't been studied enough. Everyone's been focused on the economic story. Finally, one thing to point out, Russian ruble bouncing really, really hard after a large fall yesterday because of an emergency central bank meeting that is going to be in about 82 minutes' time, where they're expected to take some strong actions to defend the euro.
Okay, a lot of news flow there, certainly on emerging markets, on China, on the UK economy. Let's get back to the China stories. China's central bank has unexpectedly cut a key interest rate by most since 2020 in a move aimed at bolstering the country's faltering recovery. It came shortly before the release of disappointing economic activity data for July that missed estimates. Let's get more with Bloomberg's China economy and government editor Jill Eustace, who joins us in Hong Kong. Jill, so we know we've seen these rate cuts, and we know that markets haven't responded all that well. We've seen the dire data coming out of China. Will these rate cuts help then? Give us some context.
Right, well, and I think that's really the question here, and a lot of economists we've talked to have said that even though this is the largest rate cut to this policy interest rate in 3 years, it doesn't really seem like it's going to be enough to move the needle. I mean, I know that a lot of economists are sitting here saying a lot of, China's problems are really systemic at this point. I'm sure the PBOC, in making this decision, they're not just thinking about this weak data that came out, showing pretty across the board slowing growth in industrial production and retail sales. They're also looking at probably that really poor loan growth data that came out on Friday. I know there's a lot of now fears about contagion
and I hope
risk
so
stemming
to
from
go down.
what's happening with Country Garden, that incredibly large
Look
Chinese
at this
developer
previous
that
day close,
potentially
and
be
then
heading for
we'll
default.
see if
We've gotten many headlines over the past several days on
we've got the
potential
bullish
entries
bearish
to the wealth
sentiment.
management sector. Looking at the $3 trillion trust sector in China. I think at this point, the general feeling is that it's not just, this one rate cut that may be enough to really move the needle. It's got to be additional measures. I think that's probably, this headline that just crossed the terminal a couple of minutes ago about this, some stamp duty actions that the government is considering at this point. Maybe that helps boost investor confidence at this point. But ultimately, I think, what a lot of people are saying, what a lot of economists are saying is that there needs to be more. Maybe that means additional rate cuts, or maybe that ultimately means some demand side measures. The idea of cutting checks to Chinese consumers, which the government hasn't considered whatsoever, maybe needed to actually get things going and really improve demand and confidence in the economy.
Well, you pointed that loan data on Friday, which was shocking, wasn't it, in terms of the fallout, in terms of the pickup in demand for yuan loans, which does beg the question as to how effective, as you nod to, this MLF cut is really going to be. Joe, when it comes to the data then, as China, every time it turns, an official's turn, every quarter they turn, they face another problem. What amongst the data stood out for you?
Honestly, Tom, the biggest thing that stood out to me today is that the government just stopped publishing its youth unemployment rate. We've been looking at this as a key gauge of economic data in China over the last several months. We know that this is the rate among people aged 16 to 24. So really, what this is largely capturing, Tom, is like that those recent college graduates who are just entering the job market. That's a rate that every single time the government has published it over the past several months, it's been about 20%. I think today we were expecting it to go even higher. The government even warned last month that it was likely going to go higher because remember we've got a record number of university graduates entering the job market this summer, trying to find jobs. We know what the economy has looked like, but today they just said we're not going to publish that anymore. We're just suspending it for now because we need to reconsider the complexities behind this data. There's some limitations in the data set, and I think that just kind of indicates that there's a lot more going on behind the scenes here. There's some concerns now that I think investors have over lack of transparency within China, but that really just stood out to me as a pretty major a shifting point within a lot of what we're getting from the government.
Okay, so thanks for the briefing. Till Decent joining us there from Hong Kong with a host of news flow out of China. Mark, let's talk about the markets in 3 minutes and start with China. We saw weakness in Chinese stocks, as you pointed out, weakness in the currency as a result of some of the data and taking some time to digest the rate cuts we've seen. Then we saw a bit of a recovery that's still in negative territory on Chinese stocks. And we don't see much of a bounce in Chinese stocks on the back of the stamp duty news. What do you make of the price action?
So probably what's most interesting on the price action today is how little movement we have seen all day. It's been just a tremendous day of news flow, and it's not come all at the same time. We had that MLF cut first thing. That should have been really good news for stocks. It did not impact. It correctly flagged that the data would be really poor. Then the data was even worse than we imagined. How do we counteract those two things, or how do we counterbalance them? Then we just kept on getting negative news flow in the property sector, but it's all kind of priced. And then we got that positive news later on that they're considering this idea of a stamp duty cut for stocks. I should emphasize they're considering it. It's not a new measure yet. That has caused the losses to pair gains. But we've really seen a really quiet movement. Now, what's interesting is, over the past month, Chinese stocks have still outperformed US stocks. They're just about ticking into negative territory, but in fact, given the stamp duty headlines, they might again be positive over the past month. They have not been underperforming the rest of the world despite the news flow. People do not know how to interpret this at the moment. We're just getting so many announcements on policy, which there's no real delivery on. We're getting a very clear picture that the economy is an extremely tough place. Remember, this is a tough place for an economy that should be growing at over 5%. So does that mean that we're going to get years of 3 or 4% growth? That's still way faster than any G10 country. People are trying to work out. What I think is most interesting is the price action. It continues to be incredibly resilient, even though we're not getting positive news. And that, to me, is probably the biggest takeaway.
Okay, another theme of the week has been the higher yield story, and the higher real yield story there, Mark. Really catching some by surprise, no doubt. A 14-year high on 10-year real yields. What's the broader impact of this development?
I think this is a really, really big impact across assets. It's hard to know what all the factors are going to be. I think one thing that's really important is at the moment, short-term it's supported the dollar and it's weighing on emerging markets. I think the reality is we're going to be moving into a backdrop of where we have sustained higher real yields. We need that to be the case because we've moved back into a world we've not been to for at least 20 years and arguably much longer, where inflation is the real threat. There's no threat of deflation right now. We need sustainably higher real yields. So I think the world has to adjust to the fact that they're going to continue going higher from here. What is the true knock-on to other assets? I'm not really sure. But I think one of the things that people are coming around to, maybe not partially into the real yield story, is the fact that when it comes to treasuries, most of the market guests we've had on this year, all year, we talk about buy duration, tight buy duration, near the end of the cycle. I think people need to realize that it's not just about economics there, it's demand and supply. Maybe it's a different part of the economic market to think about. There's a lot of supply to come into the treasury market in the coming years, and there's decreasing amount of demand for them because we've taken out central bank buying. And I think there's the natural haters for yields to keep on going higher from here.
Okay, the bigger picture, the longer picture on treasuries. Remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLID Go is the function to use on your terminal. They're across the China story, across the real yield story, of course, and crucially, Tom, across what's going on in the UK economy as well.
Yeah, we're going to discuss more, get more detailed analysis on the UK economy after that wage data came in hotter than expected. And of course, company earnings as well. In an exclusive interview, this is one to stay tuned for sure. Legal and General CEO Nigel Wilson. Plus, Warren Buffett's Berkshire Hathaway slashes its Activision stake and buys up more home builder stocks in its latest filings. We'll break out the details beyond that. And up next, the United falls to a 9-month low as Mark was flagging for us against the dollar. That's as the PBOC announces that surprise rate cut. We'll look at how markets are reacting to the latest out of China. And of course, if you have any questions of your own for our guests, please send them to us on IB Plus TV Go. You can also get more from the Markets Today team on the front page of the Bloomberg UK website or by typing T-Live Go on your tab. This is
Okay, so we saw the reaction for the news on UK market. The news which was today, it was about the unemployment rate and the claim card charge. Market gone up, and I expecting it will drop now after that. And the other news today, it's nothing important till Canadian and US news just before the market open. So currently I'm in a short, and I hope so that short will work nicely.
Welcome back. European futures pointing up by around 0.4%. Let's get you up to speed on some of the other top stories you can find on your Bloomberg terminal and on Bloomberg.com. Donald Trump has been indicted in Atlanta over alleged efforts to undo his 2020 election defeat in Georgia. It adds a fourth criminal case against the former president as he campaigns for a return to the White House. Trump's lawyers called the indictment, quote, flawed and unconstitutional. Argentina is hiking interest rates and devaluing its currency as assets went into freefall yesterday. That was after a populist who vowed to burn down the central bank won surprisingly strong support in a primary vote. The government rushed to devalue its official exchange rate as much as 18% and hiked its key interest rate by 21 percentage points to 118% in a drastic policy shift as it runs out of funds to defend its currency. And Russia's central bank has called an extraordinary meeting for today after the ruble crashed through the level of 100 to the dollar for the first time since March of last year. With the war in Ukraine dragging on and international sanctions hitting trade, last month saw Russia's central bank hike its key rate by a percentage point to 8.5%.
So that's a rundown of some of the top stories we're covering. Certainly a lot of emerging market news flow. More on that shortly. Let's stick with some of the things in markets this morning. And China, certainly one of them, with the weak data set, the cut to interest rates coming through, a medium-term loan facility, 7-day facility, all cut. And also this talk now of the possibility of cutting stamp duty on stock trades. All of that should be positive for stocks. Hasn't managed to be positive for stocks. So it's certainly negative for the currency. Heading into Backmark, Senior Portfolio Manager at Allspring Global Investments UK, joins us now. Henrietta, a lot to talk about this morning globally, but I want to start on China and the sort of mood music coming from China as we see data that is weak being met by policy response. But I wonder what stands out to you, whether any of this is enough to change your thinking on China.
Yes, China is one of the areas of concern at the moment because it's got some deep-seated issues. There's been the unrest that's been rumbling on the property market, and that's continuing, and we've had some further news there. You've also got the challenges that they're facing with the China Plus One policies and the onshoring that we're seeing elsewhere in the world, the de-risking of the relationship there. So there's a lot going on the Chinese front that they have to deal with. Our thoughts are, though they have surprised the market this morning, is that you're going to be careful about riding to the rescue.
We got continuation signal.
Given their behaviour in the recent months. So those are three factors that make it challenging at the moment for China. That being said, there are areas that they're quite strong at the moment. Go for it.
And one of the things that I thought was interesting to note was talking about US equity versus China and Europe on a relative growth story. Now, obviously, even though China growth is very much disappointing, it is still going to grow much faster than the US this year. According to most, even unofficial estimates, it might be below the official estimate. So, when you say that on a growth story, do you mean that it's all about relative to expectations? And do you think that those growth levels, as forecast at the start of the year, were accurately priced for the stocks then? So it really is all about disappointment or exceeding expectations?
I think so. As you say, there are still going to be a share of global growth, and we expect that to continue, but at a lesser pace, maybe than initially expected.
Henrietta, is there a broader global risk emanating from China? To what extent is this going to be contained, or are you thinking about positioning for some spillover effects now?
It's a mixed one. It's actually been reasonably positive in a sense because it hasn't put as much pressure as could have been in the first half of the year on all things commodity related, where markets are in places still tight, and we're seeing that at the moment. So that's actually been helpful for the global economy because we haven't had a China roaring back and consuming. That being said, we are seeing slowing down there. That could have spillover impacts, but we are getting support packages, particularly in the US, in various guises that are supporting growth and also helping that decoupling between China and the US. So yes, something to watch, but we're seeing that as more of a China story at the moment, with rates being more of an influence and inflation being more of an influence in Europe and in the US at this point.
Henrietta, this summer seems to be bring plenty of news flow to digest, but some fairly typical choppy market action. How are you investing around this? And I'm thinking of some of the moves you've made recently around REITs and financials, where you trimmed and overweight. What sort of sector views are you focused on right now?
So looking at the fixed income space, we are interested by the yields that we're seeing in certain areas of markets. And we had some of the noise around the financial sector earlier in the year, and we actually took the opportunity to add there. Spreads have come in that sector. We've had some issuance as well. So we're looking to trim some of those positions as the spreads have come in. REITs has really been one of the areas that's seen a little bit of pain over, particularly at the beginning of the year and into last year, given rates move. Again, over the summer, interestingly, we've seen the spreads in those sectors come in. So we've taken the opportunity to lighten up a little bit there to give us flexibility further down the year if we have some volatility in those areas to pick up some paper.
Henrietta, you made the point there that spreads have come in some of these sectors like financials and REITs, but obviously yields continue to go
Okay, I will
higher
start
on this
printing
just
the
increasing supply dynamic.
trading stop
By the month, and we no longer have QT to knock
for
it
the
off. How concerned are you
bulls.
by that, and particularly on the real yield dynamic,
I
where 10
took
and
the
30 year real
TP1.
yields are up at multi-year highs. Two-year real yields will probably get there today as well.
Okay, I can leave the stop as we are on 8,
Yes,
almost 9
yields
points.
had another leg up. We had a bit of
Maybe
a
the best will
cocktail
be
in
now if the
terms
price
of
go below
raising down rate in the
Robert
US, the
Greenfield.
announcements on supply, and you
200
also
milligram
the
shorting
DOJ.
the
I
price.
think that's also something to note in the movements that we've seen on the yield side. Again, we've had strong
1.5
employment data this
or
morning
here.
out of the UK. Central banks still have got an eye on what's happening on the inflation picture, and we're seeing that play out in yields. I think the supply side, yes, it is something to take into account, but I think it is going to be driven by what happens on the inflation front and also growth. It's seen more resilience than many economists have anticipated since the beginning of the year.
Henrietta, just very briefly, on the wage front around the UK, oil prices up, 20% since the end of June in terms of Brent. Is there a complacency in these markets about a potential resurgence of inflation?
I think it's something to watch, certainly, and the sort of movements that we've seen on the commodity side is something to keep an eye out on. I don't think we're quite in the same situation as we were last year. I think supply chains have moved around, but we are getting pressure points. Still around Ukraine and the situation there, Australia on the gas side. So it is something to keep an eye out on.
We appreciate your time. Henrietta Beckman, of course, of Allspring Global Investments. We're going to be speaking to LNG CEO next. This is Bloomberg.
One short as well with gold.
Welcome back to markets today. Happy Tuesday. We are a little under 30 minutes from the cash equity open, and here are your top stories. China's central bank announces a surprise cut to a key rate amid further signs of economic slowdown, with retail sales among the latest batch of disappointing data. The pound gets a pop as UK wage growth accelerates to the strongest pace on record, adding to concerns that a tight labour market is feeding inflationary pressures. And Donald Trump is indicted in the state of Georgia over efforts to overturn the 2020 presidential election. Let's check in on these markets as we weigh up the additional responses coming through from policymakers. Is this the thoughtful response from Beijing, or does it smack of desperation when we have a cut to the medium-term lending facility and then a cut to stamp duty for the first time, I believe, since 2008 when it comes to Chinese equities? Futures pointing higher in Europe as we weigh all of this up. We look ahead, of course, to the FOMC minutes out on Wednesday to give us a guide in terms of the next steps from the Federal Reserve. Yields back up yesterday, particularly on the 10-year, the highest level the yields have got to since around November of last year. Fresh futures over in France, CAC up 0.3%. Here in the UK, then, gaining just 0.1%. We saw that pop in the pound, of course, that wage data coming in at 7.8%. The strongest wage data on record. What that means for the BOE, another hike now looks imminent, doesn't it? We'll be checking in on gilt yields when they start trading gilts at 8 a.m. UK time. DAX futures over Germany gaining 0.4, 40 points, 0.2, close to 0.3 of 8%.
Yeah, I think 7.8%. You're right. It's 8.2% if you include the bonuses. So certainly some stunning figures when it comes to wages. We'll make that part of our conversation and look at the UK economy with our next guest a little bit later. Legal & General has reported operating profit for the first half of £941 million, slightly lower than the year before. The firm, which is one of Europe's largest asset managers, says it's still on track though to achieve its 5-year ambitions. I'm very pleased to say we welcome the Legal & General CEO, Sir Nigel Wilson, who's on set with us here in London. Thank you very much for coming to talk to us, Nigel, about the numbers and much beyond. There's so much to talk to you about the UK economy and about policy changes that we've seen that I know that you've talked about in the past. But let's start with the numbers. You're saying in this morning that you are on track to achieve your 5-year ambitions. So what is this sort of data release, this only for talk me for the business?
We're very confident about what's going on in the UK and our markets and internationally as well. And that we set out 5-year ambitions 3.5 years ago, and we're definitely on track to achieve all of the targets that we set ourselves. So we're feeling pretty good about life.
Okay, Mark.
Nigel, good morning. We joked earlier on about always happy with these results, but I want to move on from the results, because the results were roughly in line, all fine, you're happy with them. Any insights to how the Solvency II reforms are developing? And specifically, are they going to lead to meaningful infrastructure investment? And on what kind of timeline?
I think it's a very good question to ask, because I think we've seen policymakers, regulators, and government all working together with industry for the first time in many years, trying to look at the structure that allows us to invest more in the economy. When you think of what a fantastic job they've done in America in terms of getting a boom in investment, a boom in manufacturing, we have to take some of those really good ideas and replicate them over here. We've now been given the structure, Solvency II structure, to do that. It's up to our regulators and ourselves to implement it much quicker than we're currently planning. It's currently planned for the back end of 2024. We'd like it certainly much earlier in 2024, so we can really step up our investment. Our balance sheet is the strongest it's ever been. We've got a lot of firepower to invest in the UK. We'd like to be given a bigger opportunity to do that. The second big issue is really planning, and how we sort out planning, not just for commercial operations like ourselves, but also for the national grid. So actually it could cope the huge demand that's going to come their way as a consequence of the transition to net zero. So we've got a massive opportunity sitting in front of us. We can see the Americans grabbing it with two hands. We've got to replicate it and replicate it at pace.
Nigel, I want to get a little bit more detail, a little bit more colour on your views on Solvency II. We touched on the implementation. You want to be implementing this new industry well before the end of next year. Just give us a bit more certainty around that time frame. Your expectation for when the implementation will be happening, and when you can really start to see a meaningful impact.
Okay, I try to shut the oil. I hope so. It's not bit too early.
There's multiple moving parts around this. The Prime Minister, the Chancellor have been very positive in the Mansion House speeches for the reforms that we've already got in the pipeline. We've now just got to speed up. It's there to do. Whether it's the first half or second half of next year, it's in a biggest macro sense not a big issue. But for us, we want to crack on and get going and do more things. We've got amazing projects in Manchester and Oxford and Bristol and all around the country. And there's lots of metro mayors and vice chancellors of universities saying, give me some money, give me some capital, make these things happen. And we're there to do that. And we just need policy nudges from the government.
So maybe the bits of the balance sheet then freed up by the change in the Solvency II rules as discussed. But also, you mentioned the Mansion House address and how that is trying to push more money into startups. What material difference can that kind of policy make then, Nigel?
Massive. I mean, if we truly want to implement that,
It was hugely overbought, and this was like very nice running in the morning, but oh, you've got that.
They're very hard on themselves, even though they're so much better than this.
And they can run for a long time in the same direction.
Around DC pensions.
It's very voluntary, isn't it?
But auto enrollment was voluntary. We have between 92 and 100% people who it's soft compulsion is the way we think about it. You can call it voluntary or soft compulsion. It's not hard compulsion. But this is a good thing to do with good customer outcomes, good societal outcomes. Even from our point of view, if we allocate 5% of our assets, our DC assets, that's 7.5 billion just from us flowing into startups and scale-ups across the UK. That will make a difference.
Nigel, you've hired Antonio Samos to take over as CEO in January. And I'm going to phrase this question controversially deliberately.
This is my final
What direction is he going to take the company, or is his job to maintain the status quo?
It's about 61% retracement from yesterday.
I didn't hire him, by the way. I think he was our board who technically hired him. Obviously, we're ex-McKinsey colleagues, so I know him very well. I mean, Antonio is different from me. He's got much more charm.
The second DP I got around the previously close area.
He'll make a big impact on our business, given his skills and background, particularly in international, where because of COVID, I don't think we've grown internationally as fast as I would have liked to have achieved. And I'm sure Antonio will do a better job than I've done in getting us to expand our model, which is hugely successful in the UK and is showing very promising signs in America and Asia, in Europe, and indeed in the Gulf. We can build on that platform. He'll probably accelerate the growth from what I've been able to achieve.
Nigel, what
gold going very well.
As an investment destination?
I really think this is a big issue. I've been to China, to America, to Europe, to the Gulf, and obviously all around the UK in the last couple of months. And the perception of the UK externally is not as good as I'd like it to be. And that's really, I think, what's behind your question, is I think our potential is in
My
A
first
minus,
TP is
but the perception is a B
new
minus.
low.
And we've got to change that gap between
Testing
what
sort
people
of the
perceive we can
previous
achieve
low.
in the UK and what I think could be
Which is
done
at
here in the UK. And that's one of the things I
30.5.6.
want really the industry, the government and the regulators to work together to get a consistent positive message about the opportunities for the UK. As you can see, the labour market's very robust. We have fantastic universities. We've got huge capital shortages across the UK. So we've got matters of potential. We've got to seize that potential in a way that we have done over the last 13, 14 years, but lots of other people need to do it as well.
Okay, so that's the structural change that is coming, and you're obviously very confident about. What about the shorter-term challenges for the economy, and some of those born out of strength, actually? So we're seeing a stronger UK economy than many had anticipated, but that has headaches, doesn't it, for the Bank of England amongst them? I mean, looking at this wage number this morning, coming in at 8.2% when you include bonuses. I mean, this is, from your perspective as someone who looks closely at interest rates, of course, and is very immersed in the UK economy, how does this UK economy feel to you?
It's much more resilient. I mean, the big picture is that both the UK, the US, and indeed the European economies have been much more resilient than anybody thought. And actually, there are lots of lags between policy. And raising interest rates is not causing unemployment. It's not causing wage demands to go down. We're still seeing consumers who are very confident in spending. It will have an impact on other parts of the economy.
Nice, first TP down on gold. I'm breaking now.
In interest rates. So there's lots of things happening in the economy which are all economic models
Let's see
didn't predict. And it's
how
actually not
far
comfortable
can we
at
go.
modelling themselves. And indeed, the Bank of England have made that point themselves. We all know
Oh,
inflation is a
it
bit
doesn't look
stickier
like
than we think
that
it's
we
going to be.
rejected.
But
We got
let's just
the
assume it is a bit stickier than it's going to be.
purple
And
and
not
red
set
line
unrealistic
start printing.
expectations that it's going to be down to 2% by the end of the year. None of us really believe that that's going to be the case. So we have to manage our business in a different way. We recognise that actually the compete for labour, you've got to pay people.
Same is with the
Nigel, what are
NQ,
your plans for
and 20
2024?
points
I don't
up.
think any regular viewer, any of us, was surprised to hear politics was in the mix there. Can you give us any
20
more
to
clarity
go
about
to
what
my
you're trying to do?
second TP.
I'm getting through this set of results. I'm waiting for Antonio to
First TP on oil is on 80 to 67.
on me time. But at the moment, I'm 24/7 focusing on legal in general.
But not ruling out
So
politics.
it's around 200
I'm
on
not
the
really at
average.
anything at the moment. My dream is to play for Newcastle United. But
There we
I
go.
don't think that's
We
gonna
can rule that in too.
happen. Yeah,
Okay, Nigel, thank you very much. Legal and General CEO Nigel Wilson, fully committed, fully focused on the Legal and General job at hand. We'll see whether politics is in his future. Coming up, we will look at your stocks to watch at the open, including UBS, which has agreed to pay $1.4 billion to settle a case with the US authorities regarding how it handled residential mortgage-backed securities. This story goes back a long way. We'll get the details next. This is Bloomberg.
Okay.
Welcome back to Markets Today. 7:44 in London, 16 minutes then until the start of cash equity trading for this Tuesday morning. The futures picture points modestly higher, looking to catch up a little with the US stocks of yesterday, although US futures also point slightly higher this morning. Let us get to Mark for his Caught My Eye segment this morning. What has caught your eye? I know emerging market FX, there's been plenty of that to talk about of late.
Absolutely, it is emerging markets. Lots of big stories yesterday. Argentina devaluing was one of the big ones. Russian ruble in free fall. That means we've got an emergency meeting in about 45 minutes there to defend their currency in free fall. Nigerian naira losing reserve support. It fed through the whole EMFX spectrum. We saw Brazilian real have a bad day, Colombian peso have a bad day. Even relatively stable currencies like the Vietnamese dong in Asia were suffering this morning. And of course, the backdrop behind all this is we know that the yuan is under pressure. It's actually been outperforming because of PBOC support, but there's a lot of natural market pressure for it to continue depreciating. So I just want to draw attention to the JP Morgan Emerging Market FX Index, and this is now at a multi-year low. In fact, this index, the data we have goes back to 2011. This is at a fresh low for that 12-year history. And the backdrop, basically since the GFC in 2009, we came after a big EM supercycle of gains. Emerging markets have been in a long-term struggle. This year was meant to be a big turnaround. Emerging markets have hiked first. We're getting towards the end of the cycle of developed markets. And this is really about, here's the time for emerging markets to return to the carry traders back. I will admit, I kind of bought into this idea. I knew it'd be nerdy, but I thought it was going to work. Well, I have to say, it has gone really wrong since about May, as we've realized the Fed has more work to do. And unfortunately, the losses for emerging markets are really starting to accelerate on the downside as these scare stories are spreading throughout the broader mix. The final point of saying this is that obviously, even though China is only a small part of this index, the China sentiment influences the broader story. So if the China story turns around, this could bounce, but that's not looking soon.
Yeah, that's the key caveat, isn't it? If the China story ever turns around. Mark, thanks very much indeed. A big week then for EM. You can't talk, of course, about emerging markets without that thread of energy tying into the emerging market space as well, particularly when you're thinking about China, of course. I wanted to draw your attention, the viewers' attention, to the must-read of the morning for me, which is the opinion piece from David Philippine, which I know, Mark, is of interest to you as well. And what he's pointing to is the disconnect that we see between the forecasts, the very bullish forecasts, from the likes of the International Energy Agency, their most recent forecast on Friday for 102 million barrels per day in terms of crude oil consumption by the end of this year, a fresh record. The disconnect between those kind of forecasts and what's actually happening on the ground in terms of oil producers and those who are consuming. Saudi Arabia, on the production side, of course, cutting by 2 million barrels a day because of their concerns about the uptick and the suck-in, the pulling of the consumers. The consumers, of course, China, a big part of the mix there. Officials say that gasoline production, in terms of the gas they put into their vehicles, that's probably peaked because they pick up in EVs. So what is the disconnect between these bullish forecasts like the IEA and what is actually happening on the ground? Well, David points out that actually when the forecasters are talking about oil demand, they're also talking about, for example, biofuels that go into these refineries and NGLs, or natural gas liquids, that also go into refineries. And they are taking up a bigger share of the market as demand for crude remains below those 2019 levels. And what David's pointing out is that maybe demand for the black sticky stuff actually peaked in 2018, even as biofuels and NGLs continue to increase their market share. So it's just something to think about when we consider that demand picture in terms of oil, and this chart breaks it down.
Yeah, really interesting. They're breaking down the different parts of that commodities complex. And let's think about where commodities sit right now, the China story, how that all pulls together in terms of the market's focus. 12 minutes before the start of equity trading here in Europe. Let's check in with how things are being covered on the Markets Today blog. Christina Aquino joins us from the blog team, as you can take us through the thinking. I'm going to switch the order around a little bit just to jump off what Tom was talking about there on the commodities space, Christine. Clearly, commodities in focus because we have this data set coming through from China. The data looked disappointing. We've got the rate cuts, of course. A little bit of movement upwards in oil prices this morning. It seems that different markets responding differently to what we heard out of China.
Yeah, absolutely. And I think when it comes to the commodities complex, I mean, that is very much the question, right? Is the support from the Chinese central bank and perhaps the Chinese government eventually, is that going to be enough to revive demand in China and therefore revive demand for commodities? I mean, we did see oil initially falling in the aftermath of that action from China. It's stabilizing a little bit now as traders kind of try and chew through these questions, because ultimately I think what we're seeing now is kind of a game of tag between markets and the Chinese authorities, right? I mean, markets kind of clamoring for more support from China. China delivers that. It's not enough for markets, and therefore we're getting this sort of reaction. And so it really is a question of when do we get to that point where markets are satisfied and we do finally get that full-fledged revival in the Chinese economy and therefore in the commodity space.
Christine, good morning. We had some extremely strong wages data out of the UK earlier this morning. What's your take on that? And do you think this is going to really hurt the UK equity market today? I know the pound is slightly stronger, yields are slightly stronger. Seems like a bad dynamic for the FTSE.
Yeah, Mark. I mean, all those rate-sensitive sectors in the FTSE 100, we're definitely keeping an eye on the Markets Today blog. We're talking about home builder, we're talking about commercial real estate lender, we're talking about banks, right? All these kind of sectors very much related to the prospect that we could now get a 6% Bank of England rate. That's what we're seeing in terms of traders' bets. That's a 22-year high. You know, it's not something that we've seen since the start of this millennium, and so it is quite significant. And as you mentioned earlier, quite a big headache for the Bank of England because that wage growth number, record pace, really shows you that inflation is becoming much more sticky in the UK.
Okay, Christina Kinner from our Markets Today blog. Thank you for walking through some of the key market themes as we lead up to the open. You get more, of course, from the team on the front page of the Bloomberg UK website or by typing TLifeGo on the terminal. Let's cross over to Joe Easton now from our equities team, and we talk about the UK resilience. Resilience as well, it seems, Joe, in M&S.
Morning, Tom. So Marks and Spencer's today giving us an unscheduled trading update saying that their food sales have grown by around 11% in the 19 weeks through August 12th. There is a bit more weakness in the clothing. That's only up around 6%. And they do caution on some uncertainties around the economic outlook. However, we've already got Morgan Stanley giving us an early update on their earnings estimates. They're raising their earnings estimates for M&S by about 10% and also upping their price target as well. Now we can see this stock had a really good run already this year, up around 66% on hopes that it could reinstate the dividend that was cancelled during the COVID-19 pandemic. And I would expect there to be a bit of a read across on some other stocks in the UK retail space today. That does look potentially strong, though, as you say, that wage data is the backdrop. Here's a few of the stocks, how they've performed in terms of retailers this year, all looking solidly green. We're also going to stay in consumer, but go over to Copenhagen, where we've had earnings out from the retailer and jeweler Pandora. So they say that sales could hit around 5% in terms of growth. They previously expected sales to grow around just 3%. Now Europe is a stronger market. They're pretty much flat in terms of the growth there. And the US is actually pretty weak, down around 4% in terms of these sales over there. But that stock, it's another one that's had a pretty strong run. Virtually brought it up versus Novo Nordisk, the other big Danish company that's been doing really well this year. As we can see, Pandora just trading that stock slightly, but it did follow a few years of profit warnings for Pandora. There does seem to be a bit of a recovery on that one. Finally, we're going to look at UBS. They've announced a $1.4 billion settlement with the Department of Justice over legacy residential mortgage-backed security issues. Now, this is $1 billion factored in by analysts, so it looks to be a positive settlement. UBS did actually try to have this dismissed from court, saying that their staff did not know of the contents of some of these products, these residential mortgage-backed securities, but they haven't done that. They've settled this, and that could potentially be positive. We can see
Okay, we're waiting for London to open.
where it was
Nothing
before they did the Credit Suisse
too
takeover. I
interesting.
would know there's a no
The
term
gold
from
trade
Barclays today saying that
going well,
is now
but
overvalued.
after hitting TP1 we got a standstill.
Okay, thanks very much, Joe. Our equities reporter Joe Easton with the latest on some of the stocks in focus.
And maybe I'll put my stop loss to my original entry as I don't want to enter so many times. That was a quite nice resistance. So
I think a lot of people saw that coming anyway. Big pressures that way in November.
I will move it higher from break even just to be ready for the London Open.
Gilt markets open, of course, in around 7 minutes' time. But we are also
And the oil trade as well was going nice. My TP1, it's at 67.
8.2% year on year for wages. We're meant to be beyond the big inflation beat. That's
So
a small
let's
big target,
see.
but it's more than four times the target of the Bank of England's inflation level. This is a really, really hot print. It does tee us up for CPI tomorrow, which we're expecting to be soft. finally those basic facts are going to come in. UK inflation is the last country to play ball in that disinflation story. But yes, it does feed the global yield story, and it's not helped by what's happening on the energy front either, which you mentioned earlier on, Anna, that generally yields are going higher and higher today, including real yields.
Yeah, and that is more bad news for the real estate sector, the property sector of the UK, as we look ahead maybe to 6% in terms of the terminal rate from the BOE. Mark Cudmore, of course, thank you for spending the past hour with us. Reunited briefly, and tomorrow. Futures pointing higher in Europe by about 0.2%. The open is next. This is Bloomberg.
Oh, having it open. Let's see what London will bring us if dollar can go lower.
A few minutes to go until the start of cash equity trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom McKenzie.
And here are your top stories. China's central bank announces a surprise cut to a key rate amid further signs of economic slowdown, with retail sales among the latest batch of disappointing data. The pound gets a pop as UK wage growth accelerates to the strongest pace on record, adding to concerns that a tight labour market is feeding inflationary pressures. And Donald Trump is indicted in the state of Georgia over efforts to
Okay,
overturn
London
the 2020
opening in 20
presidential
seconds.
election. It's
So we
this
can
morning
see
as
some
we came
orders
into the
start to
studio,
build
it's all
in.
about China, with those additional measures coming through from Beijing. Too little, too late, maybe a question. And then the UK coming front and centre with wage.
Absolutely. We pulled both of those together, those themes, ahead of the market open this morning to have a look at some cross-asset movements in markets. This is the pound then, 127.12, up by 0.2%. The market looking to price in a rate cut in September, questions over November then loom. CSI 300 down 0.25%, off its earlier low, then, Tom, in terms of the response we've seen in markets to the weak data, the rate cut in China not doing enough to turn things around, and the same applies to the
Okay,
currency.
London
We're
market
seeing the
open,
currency
and
losing back
let's
3
see if
tenths
we
of a
can
percent.
go
And
lower
the
now.
gas price here for Europe, the benchmark, we've seen a lot of volatility in that.
Oil
Down
going
those
towards
levels
the
above 40
target.
euros a megawatt hour that we saw. And a focus on inventories pulled it down yesterday. We'll see if the same happens today. Tom, what do you see in
Gold
futures?
is
Okay,
on a
volatility in the gas
standstill.
markets then back for us. We check in on the futures then. A bit of a soggy start, it looks like.
Okay, oil hit the target. That's
All of
nice.
those inputs coming through from China, the UK growth picture, of course, inflation.
And I am break-even right now.
Futures pointing to modest gains of about a tenth of a percent. 5100 futures now flat. So look at that pop in the pound. The cat are up, just gaining a little under a tenth of a percent.
Let's have a look then at the start of the European equity market, and we are watching for the gilt market, and it's in there already. UK 2-year gilts, I can see jumping into the sovereign bond column here on the GMM, and the 5-year is there as well. So we are seeing those yields going higher in the UK, reflecting that higher yield story. It's a global story, the higher real yield story, the higher yield story that we've been talking about with regards to treasuries. There's that sort of global dimension, but there's also what's going on specifically in the UK with the Bank of England still hiking rates, and perhaps with more to do in terms of hiking rates than other global central banks. So the UK very much in focus, but that movement in yields higher is in very good company. As you see across Europe, we're seeing yields going a little bit higher today, reflecting perhaps that 14-year high in real yields over in the US yesterday, a big talking point, one we will return to. So yields opening up this hour, stocks opening up this hour then, Tom, across Europe, and we see tentative moves higher. In fact, these moves not as big as we might have been led to believe by the futures market.
Come on, kill.
We're suggesting some slightly bigger gains for European stocks. Things looking pretty muted as we deal with the strength in the pound and yields going higher, sell-off in sovereign bonds as a result of a high yield environment, which still seems to be very much with us then. Tom, what do you see in sectors?
Well, yesterday it was financial services near the top of the list. It was basic resources and energy near the bottom when it comes to these sectors. Today, a slightly different picture. We had a positive session, of course, stateside when it comes to the tech story. The biggest tech gains you've seen in about 2 weeks. The Nasdaq was lifted on the back of that news. Tech then as a sector here in Europe gaining 0.4%, but you have to wonder how long that's going to hold up in the face of these higher yields there. In terms of energy, gaining just 0.3%. Basic resources recouping some of the losses of yesterday on a sector basis, up 0.2%. 3 of the main sectors that we look at in the red, just down by a tenth of a percent on food. Industrials currently unchanged. Utilities, that risk off tilt not playing out for that sector at this point, but again, very muted really across these markets. Utilities down just a tenth of a percent. That is a reflection across these sectors. For me, standing out right now is technology and energy, but again, how long is tech going to hold up in the face of high yields?
Yeah, we certainly saw some tech moves higher, didn't we, on the Nasdaq yesterday. So European markets perhaps catching up with that a little bit. We saw the best day for tech in some 2 weeks yesterday over on the US equity markets. Let's get back to the gilt story then, Tom, because I'm just taking a look now at, we saw it on the GMM there, popping in with those sort of outsized moves for the gilt market. And actually, I'm looking at across the UK curve, every part of the curve, we're seeing yields go higher, up by 4.6 basis points at the 2-year end, the 10-year up by 3.9, the 30-year up by 3. So we are seeing this across the curve, not huge moves, and they are in good company, as I say, in terms of the broader European story. Let's dive into some of the things we're dealing with here then this morning. Christine Aquino still with us from the markets today. Well, Christine, let's start with the gilt story. So as I say, across the curve then, we're seeing gilts go higher, the market moving to price in more certainty around the 25 basis point hike from the Bank of England in September. But this is a part of a broader story as well, isn't it? As we see yields in Europe broadly moving higher, and the real yield dynamic in the US.
Absolutely, and I mean, really, focus has been on the idea that yields are just marching higher across the globe, particularly on the long end. I mean, we're not necessarily seeing that now in the UK. That move is still being led by the 2-year, which makes a lot of sense, right? Expectations for Bank of England rate hikes definitely more sensitive to that is the 2-year part of the curve. But overall, in the US particularly, real yields hitting a 14-year high. I mean, that's astounding. And in a lot of ways, as we've heard from the likes of Bill Gross, for instance, and that's just kind of a move back towards historical norms, right? And this is kind of the new normal that we're getting back to after more than a decade of super low rates. And it's paying off for a lot of investors if you are a buy and hold investor. Maybe not so much if you're actively trading in these markets.
Yeah, nominal yields on the 10-year currently at 4.21 over in the US, pointing, again, underscoring Mark Cardinal's point, as you were articulating there as well, that maybe we just had to get used to this environment of high yields at the back end. Here in the UK, as you say, the front end, that's where the action is, up 6 basis points on the 2-year at 5.14. I was off yesterday, and suddenly the emerging market world was thrust front and centre in terms of the news agenda. Where were things in terms of Argentina, Russia, Brazil. What is the EM space focus now?
Yeah, well, Tom, it is quite unnerving that we suddenly saw these kind of idiosyncratic risks popping up simultaneously. Of course, Argentina, we got currency
KTP
devaluation overnight
to
because of the
is
victory of the
almost
Argentine
there.
president, who, amongst other things, wants to abolish the
Come
central
on.
bank and dollarize the economy.
Not yet the president.
Yeah, not yet president incoming, but yes, certainly
Contender.
yeah, that's something that's not necessarily being taken by investors positively. And then the Russia story, very separate from all of that, of course. Again, this weakness, extended weakness in the ruble, really not doing well for Russia, especially because the value of their exports are falling. They're having to import more. It's kind of really a bad time for their currency to weaken. But yeah, I mean, overall, it seems like the sentiment in EM suddenly taking a turn for the worse, especially now that the real yield story also contributing to demand for dollars, which conversely is just bad news all around for EM.
Yeah, currently looking at ruble, currently down around close to 5%. We have that emergency meeting, as you say, from the Central Bank of Russia later this morning that we'll be watching for after the rate increases, recent rate increases there to kind of shore up the ruble, which so far haven't worked too well. From our markets now, team walking through some of the key themes. Thank you very much. Indeed, you can get more, of course, from the wonderful team on the front page of the Bloomberg UK website or by typing T-Life Go on the terminal. Let's check in on some of the individual stocks on the move with Joe Easton. Joe, what is standing out to you?
So Marks and Spencer's off to the races, Tom, up around 9%. That's the best gain in about 5 months, and it is the top performer on the Stock 600 after they raised their sales guidance, mostly related to food, but they say sales have risen about 11% in the last 3 months. And as I say, that's the best performing stock we've got this morning. Pandora also in the retail and jewelry space, they've raised their guidance as well. A bit of weakness over in the US, the Americans not being romantic enough, not buying enough jewelry, but that one's still gaining on the European strength. That's where all the big growth is coming, according to the firm today. UBS up around 0.8%. They've settled this mortgage-backed security case with the US Department of Justice. That broke overnight. About $1.4 billion. That's less than the $2.6 billion that analysts had factored into their estimates. So that's still edging higher. It's had a good run following news at the end of that backstop with the Swiss government last week as well. Now, Legal & General, we had the CEO on just a few moments ago. They're seeing outflows of their asset management business, and that one slipping around 0.9% on the UK market on the backdrop of that strong UK wage data as well, which is pressuring a bunch of sectors in the UK this morning. We're going to flip over and look at a couple of the other earnings stories. So Alfil, now this is a Dutch-listed energy storage company. They're saying that clients have overstocked on their EV battery equipment, their electric vehicles, and that stock dropping around 5% on a profit warning this morning. Brought up LVMH just to check in on some of the China-exposed shares, given all the focus on the Chinese central bank. And that one coming down very slightly, but not huge moves. Luxury, obviously very dependent on the Chinese market. ASML, meanwhile, we saw a big jump in Nvidia over in the US yesterday, pushing up all the chip stocks. So that one, a bit of a read across there, up almost 1% in Amsterdam. Taylor Wimpey I had just for the UK read across to this strong wage data coming ahead of the CPI, of course. Those stocks under a little bit of pressure, but perhaps holding up a bit better than expected in terms of the domestic UK shares. Then finally, we're going to flip over and look at the ratings changes. So there was a good note out from Bernstein on the consumer staples goods. They say there's an interesting dilemma at the moment when consumer staples companies report strong earnings, people think there's no recession, and there's no reason to own consumer staples. They say that's not a good trade to make. And they upgrade L'Oreal to buy, but they cut Danone due to weakness in some of its yogurt sales, according to the broker. Meanwhile, HelloFresh, they have got a new price target upgrade over at Berenberg, who say that the valuation is too cheap as the pandemic recovery should continue to come through in that stock. And Stellantis also price target upgrade over at Morgan Stanley, given the union concerns being overblown, according to the broker.
Joe, thanks very much. Joe Easton from our equities team with a look at some of those stocks on the move. Coming up, we'll delve
Okay,
further
the
into
bond
fixed income
background changed
markets.
to
We have been speaking
green.
to Althea Spinozzi from Saxo.
Changed to red,
Great to
sorry.
get her perspective, in particular with these moves in gilts. We are seeing that gilts are opening lower, those yields higher up by 6.8 basis points at the short end of the gilts curve. A lot of talk about higher rates there, here and elsewhere, with the real yield story dominating in the US. This is Rico.
Come on, go, can you go lower? Good bit of the liquidity here. Next CP on oil is 80 to 48.
This is markets today. We're 12 minutes into the European trading day. Futures that's pointed slightly more positively than how things are shaping up in the session right now. The 5100 in the UK is down 0.2%, of course, as investors weigh up the implications of that much hotter than expected wage growth on the BOE. Markets now pricing in a terminal rate of 6%, 25 basis points in the next meeting appears to be locked in, with another 50 basis points also being priced by these markets. Gilt yields, if we check in on those, yields are popping at the front end. The 2-year, you're seeing yields up about 7 basis points now, 5.15 on the UK 2-year, 4.61 on the 10-year, Anna.
Yeah, absolutely. So a lot to talk about then with Althea Spinozzi, Senior Fixed Income Strategist at Saxo Bank, who is with us. Althea, let's start on the UK then, because we've seen incredible focus on this UK wage
You can see
story.
bit of
It seems the Bank of
divergence.
England
There
has
is
not
no
yet
more
managed
bearish
to get ahead of what some might call a wage price
pressure
spiral,
for now.
7.8% or 8.2%
Scalp
wages
is
higher
strong,
depending
there
on
is no
how
bearish
you measure
candle,
it.
the same is on
What is the impact, do you think, of this data out tomorrow in the UK for fixed income, the University Watch?
That's quite good sign because we try to break
Well, Anna, it's
through
bad
quite big
news
support.
because it means that the Bank
So
of
we don't
England
wanna
doesn't have
make this with
inflation
the high
under
volume.
control, and it might need to hike much more than the market expected even though the economy is obviously weakening. So we expect the Bank of England to hike up to 6%, and there is a possibility for the Bank of England to even hike by 50 basis points in September at this point. And don't get me wrong, but that's going to be extremely bad for the bond market, because at this point, bond investors will need to price more premium in yields. So what I'm saying here is that the yield curve will continue to bear flatten in the UK, while we are going to see steepeners in the US and in Europe.
Okay, so bear flattening is what you see in the UK. Do you want to stay on the sidelines then until you have more clarity in terms of that rate hike projection from the B area before you buy into yields, or are there opportunities now?
If you are a UK investor, staying in short-term yields might be an opportunity, because they still provide 5%, and it's very uncertain where we are going headed. It's very likely that we are headed towards a recession, and that's going to be bad for risky assets. So our recommendation is to stay with high quality assets and to reduce duration risk at a minimum.
Well, we've seen a bit of read across. I mean, you mentioned how the market will be different in the UK, talk about bear flattening in the UK, steepening in the US and Europe, but there is some read across perhaps from this UK data into other markets out here. So some sense of things moving in the same direction. Traders placing 1 in 2 odds on a 25 basis point ECB hike in September. That's new this morning, and some suggesting this is a read across from the UK data. Are they linked in that way?
We don't think so. We believe that Europe, the ECB, is very much done hiking, and the reason for that is that the Fed might not hike again. You see, in the US, real rates are at 2%, and they are normally restrictive enough to tighten the economy. It's very unlikely that if the Fed is done with hiking rates, the ECB will out-hawk the Fed. So we believe that the best case scenario is for the ECB to stay on the sidelines and look how the economy is going to evolve, especially with Germany in a deep recession, and decide whether to hike or not, but the probability is for them not to hike.
And you talk about the real yield picture over in the US, 2%, a little over 2%. Where does that leave your view kind of short to medium term in terms of your view on the ceiling for 10-year yields out there?
A few points away.
We believe that the long part of the US yield curve is poised to rise further. You see, Tom, when we are talking about a soft landing,
nice second to be done on NQ.
Lower growth, but resilience and lower inflation. We are scrapping that outlook, and we are actually expecting stagflation to hit by
And
the
now
end of
with
the
the
year.
question
But how the
if
long
we
part
will
of the yield curve is
accept the
going to
price of previous
behave
day.
in this
So far it looks like
circumstance
it's quite
doesn't
strong
really
rejection,
change. We
trending
are
below the
seeing
200
10
moving
years
average.
yields rising towards 4.5% and 30-year yields rising towards 4.75%. We see very strong resistance level at those levels, and we might see rates correcting then.
Are you concerned about a return of inflation up here? I guess I'm asking this globally, maybe with a look at the US story, because it's there where the evidence of success against inflation for developed markets is perhaps the strongest. Are you concerned that we return to further inflationary forces?
Yes, Anna, we believe that commodity markets right now are very tight. Energy costs are picking up. natural gas cost is picking up and it's gonna get worse by fall. So we see the risk of inflation spiking again this autumn. And what that changes is that central banks will not be able to do anything. They won't be able to hike because if they hike, they put the economy in jeopardy. But they won't be able to cut either because inflation remains a problem. So how does that translate in bond markets? Front-term yields are going to be underpinned more or less where they are, but long-term yields are poised to rise higher. And within these circumstances, we really like inflation linkers. They will gain if central banks are considering to cut rates, and they will create a hedge in investors' portfolio if there are inflation surprises.
Okay, Althea, thank you very much. Thanks for joining us. Althea Spinozzi, Senior Fixed Income Strategist at Saxo Bank. Very timely conversation there about gilts, about the move across into other markets, about real yields stateside. Coming up, what office is buying? We will bring you the details of the latest 30-year filings from the United
Okay,
States.
nice.
As
Price
everyone
accepted
looks to
below the
gain from the hype over artificial
previous day close.
intelligence,
So
where
now
analysts are
we will go
targeting them with
test the
precision.
15-minute WMA. Oil trade as well, going the right direction. Second TP is just on the corner, 48. It's 50% of daily feed. Second TP done, oil. And only gold, it's on standstill, and I am break even now because we're not going anywhere. Took the first TP, now waiting. Okay, we're testing 50% of the swing. $45 put next to 4.
This is markets today. We are 23 minutes into our European trading section. A little bit more gloomy than maybe futures have suggested. In fact, US futures Ticking a little bit lower this hour, down at 10% on Nasdaq futures after gains yesterday in technology. And let's stick with the tech theme. Warren Buffett's Berkshire Hathaway slashed its stake in Activision Blizzard by 70% in the second quarter. The latest 13 findings give us this picture. This is as hedge funds have bought into some of the biggest technology names to capture the sector's rally and all the hype around AI. Charlotte Yankey's got details for us. Charlotte, good morning. So Berkshire Hathaway, a net seller of equities in the second quarter, divesting about $8 billion. Where have they cut their positions? Let's start with that.
Yeah, so we're seeing Berkshire Hathaway has made some big adjustment in the portfolio during the second quarter. And the most notable cut is a 70% stake slash in Activision Blizzard. As a game maker, struggle with, after its proposed deal with Microsoft, ran into antitrust scrutiny. And the stake cut is quite notable on that sense. And then we're also looking at the fund also exited its position in insurance broker, Marsh McLennan, and trimmed positions in companies including Chevron. So where have they been adding position? So we see that the fund has been new holdings in home builders, including DR Horton, NVR, and Lennar Corp. And so this comes as the largest U.S. home builders shares had a pretty big good year this year. As buyers struggle with the lack of existing home listings. So these shares have really been jumping on a rally this year.
Talk to us about the tech rally then, Charlotte. The upside that we've seen, of course, come through the Nasdaq, the index, and in terms of the appetite for some of these funds to add positions within technology, where has that come out in terms of the winners?
Yeah, so Bloomberg Intelligence analysis of over 800 hedge funds studying at filings show that institutional investors made big buys into the tech sector, and we're seeing some of the most popular bets, including Meta, which attracted 5.7 million shares buying, at 6.7 billion, making it the single stock with the largest market cap increase. And some of the other popular bets include Microsoft, Apple, NVIDIA, and Advanced Micro Devices, getting the latter companies AI focused. But with that said, not everyone actually benefited from this investors' ignited enthusiasm over AI. We're seeing that Intel was actually an outlier that saw the biggest increase in the aggregate position of 41 million shares. We see that being sold. So some investors could be worried about, how the company is ill-suited for making chips that's for the bigger AI trend. And we're also seeing, things not looking so good for Alibaba, the Chinese e-commerce giant, which also saw some heavy investors
going nicely down as well. Next TP 8228.
Investors, hedge funds seem to be distinguishing between those players that are seen better equipped to face up to the AI upside, the likes of NVIDIA versus arguably Intel as it faces that restructuring challenge. Of course, thank you, Bloomberg's Charlotte Yang there on how hedge funds have been changing their positioning. Let's check in briefly on the GMS. Anna, of course, was reflecting on the fact that the downside we're seeing across these European equities was not reflected in the futures. You're seeing that down 0.4% in the benchmark European stock index. We continue to keep an eye, of course, on Chinese assets, given the impulse in terms of the support coming through from Beijing. But again, I have to question whether it's too little, too late, given the numerous challenges facing that economy. Here in the UK, the FTSE 100 down 0.7%, the leading losses coming through from the UK amongst these major indexes. Same with us, which is also down by 2 cents. This is Bloomberg.
Got the 3 contracts left. ONQ. Let's see how to spread them. Okay, oil done the target. Still got one contract left.
Antonina, here is your reminder from Wukash. Feed Kubu medication.
And with that one, I hope so. To go 8170.
Antonina, here is your reminder from Wukash.
Alexa, stop.
Feed Kubu medication.
Thank you. That's so nice of you.
This is markets today. We're 30 minutes into a European trading day. Let's get our top stories. China's central bank announces a surprise cut to a key rate.
I took one TP earlier on MQ.
The pound gets a pop and gilts fall as UK wage growth accelerates the most on record. Traders boost bets on Bank of England rate hikes. And Donald Trump is indicted in the state of Georgia over efforts to overturn the 2020 presidential election. We'll get more then, Tom, on the politics shortly. Plenty of that to talk about today, stateside. But let's focus in on the markets and what we're seeing here. We saw a pop higher in the pound. That seems to be just losing momentum a little bit as maybe the dawning realisation about the challenges the UK economy faces. We'll get to that. What do we see on the broadly in markets this morning?
Yeah, I mean, we talk about the resilience of the UK economy. Does that resilience hold in the face of 6% rates, which is what markets are starting to price in? And of course, that is reflecting in the rethink around the pound and the potential upside there. And the resilience, or at least what floor is put under the pound as you get back below, a little below 127. The last time I checked. Across the benchmark, then you are seeing losses of around 0.5% here in Europe. Let's not forget about China, because again, that surprise cut to the financing rate on 1-year lending coming through overnight, and then cutting stamp duty on equities. The first time they've done that around stock trading since around 2008. And again, the question for me really, is it too little, too late from these policymakers as they attempt to address the multitude of challenges percolating through that economy? The DAX is down 0.4%. Of course, there are those significant linkages between that German equities and the Chinese market. The FTSE 100 is more reflective, of course, of the wage data that's come through and the reassessment in terms of the rate cycle for the BOE on the back of that surprise rate growth. Down 0.8%, knocking about 60 points off the FTSE 100, back below 7,500 at 7,446. Across your sectors, let's flip it over. You did see the losses coming through from basic resources yesterday and energy. Today, most major sectors in the red. In fact, all of them, bar one. Retail just holding on to gains of 0.3%. Still some earnings coming through as well. Across the macro picture, we're weighing up the day-to-day, but the earnings is still a story for us. The autos, as a sector, is down 0.4%. Utilities down 0.7. I want to look at technology as well, because you had seen a little upside at the start of the session, and then the question for me was whether in an environment with higher rates that was going to continue. That is not holding now. So the lift, of course, coming through from the US, fading for technology, currently down 0.5%. Construction as well, when you tie that to the higher rate environment, also down 0.8%. Basic resources off by 0.8. So losses across these sectors, a more negative mood across this European equity market, Anna.
Okay, let's get to some further breaking news this morning, this time coming through from Russia. Plenty of emerging market things to talk about this morning, Tom. And we have heard from Russia this morning, the Russian central bank raising its key interest rate to 12% from 8.5%. This, of course, follows the calling of this extraordinary meeting, which has just taken place. We've just got the results of it. That followed the ruble crashing through that level of 100 to the dollar. We covered that yesterday. It was the first time we'd seen that yesterday since March of last year, as Russia's war in Ukraine had been dragging on. Of course, and international sanctions have been hitting trade. The central bank had hiked its key rate by a percentage point to 8.5% last month, and now we see this bigger move from 8.5% to 12% in one go from the Russian central bank, trying to shore up the currency. And we have seen a little bit of more strength returning to the ruble as a result. Now, let's pivot away from that story and back to the UK domestic growth story. UK wage growth accelerated to the strongest pace on record. This is adding to concerns that a tight labour market is speeding inflationary pressures. Let's bring it Bloomberg's John Seheck, who writes the Money Distilled newsletter, well worth reading in your inbox as it is delivered daily. And he can take us through some of his thoughts on the UK. Good to speak to you then, John. So how surprised were you to see the strength of some of this wage data coming through? I mean, on some measures, above 8%.
Yeah, I mean, it's really striking. The kind of wage data was much stronger than anyone had expected, and then the analysts had expected. On the bonus side, went up to 8.2% year on year, and that was distorted by some NHS bonuses, which are going to be one-offs. The thing is, even if you look at the basic pay, it went up 7.8% year on year. It's the strongest on record. I mean, records only go back to 2001, but it's very punchy. And there's absolutely no question that it's a strong figure, and it does put some pressure on the bank angle.
Does the BOE need to rethink the connection between higher rates and wages? I mean, anecdotally, most people I know, most people I speak to are kind of cutting back on spending, even as maybe their wages have gone up. Does the BOE need to do a rethink on this?
Yeah, I mean, if I'm honest, I think that this is part of the problem with the whole macroeconomic model as it is. We've got this idea of the wage price spiral in our heads, but actually what's happened is that it's the cost of living that is pushing up the need for people to ask for higher wages. And then, of course, you've got all kinds of things like we've still got arguably the NHS backlog, because now the number of people on long-term sick has hit a new record again, even this month. So that's kind of tightening the labour market as well.
Yeah.
So there's a lack of people, if you like. So the idea that the inflation's being driven by wages, that's clearly not the case. Now, the Bank of England might be worried that wages will start
Okay,
to
look
drive
like that the
inflation,
bonds,
start to
they
fulfilling.
stop
I
buying
don't
looking
think
at
when
the
you look
bit
at
of
the
the
data
inflation
that's
now
really
just before our
surprising.
box.
I mean, there are signs in the latest employment data
Still,
that
I
are
want to
signs
take
that
a
the labour
TP
market is
here,
loosening
and now have
slightly.
another runner up to at least 48 area.
Still over a
Quite
million,
nice
but
morning.
it's coming down.
The trade is
And I
99
think that
points
it's a bit too early for
up.
the bank to start panicking about this. I mean, the good news from that point of view is the next meeting isn't until the 21st of September. So there's another jobs report, and also there's two CPI reports before then.
One of them tomorrow.
One of them tomorrow. And so it could change again
Oil
tomorrow,
going
to be
down
honest.
to
Yes,
gold.
but we're
It's
still dealing with the last time
got
we
quite
saw the
a
CPI
lot
print, it
of
was above
support
7%,
here.
wasn't it? So in that context, is it all bad news that wages are not a million miles away from that? I mean, you spoke to Nigel Wilson, who likes to often tell a quite positive story about the UK economy, CEO of Legal & General. But he was quite positive. He was saying, if you don't make the assumption that rates are going to come back down, if you make the assumption that rates and inflation stay a bit higher and we've got to pay people more money at a decent wage in his view, then is that so bad? What are you thinking?
Yeah, no, I think he's right. I mean, one reason that we haven't had the recession that everyone thought we were going to have a year ago is because the wages have risen and they've helped people cope with the cost of living crisis. The other thing is, I mean, even after this report, even with wages rising at a record rate, they're only just flat in real terms. And that's using CPIH, which is
nice. Come on.
it's not fiddled, but it's slightly lower than the traditional CPI. So they still haven't caught up with inflation.
RTY, it's leading now. There was a huge
buying more, so not
liquidity
spending
area.
more this year, but buying more stuff
It was holding
compared to
us,
last
but
year, going on more holidays compared to last year.
nice
I mean,
to
I
see
don't know
it
anyone who's
break
not
it.
cutting back. That's I just see this disconnect. It just doesn't bear out in reality on the ground.
Yeah, no, I mean, I think you're right, and I think this is why I think it's not a good idea for. I think it's not a good idea for the Bank of England to keep focusing on wages as being such a big issue. We should be glad actually that they're going up and that they're keeping the economy afloat. And I mean, the other problem is that people are cutting back partly because they're expecting mortgages to go up as well.
We haven't actually seen the
Yes, if we want people to be able to cope with that, then we should hope that wages are going to keep up as well. I mean, there's not actually quite an interesting point in something else. It's slightly disconnected, but
so I
also the
expecting a
irony about these
bounce,
rising wages is that we're now going to see the
but
triple
happy.
kick in September on the state.
3 contracts left. I will take one at 92 areas, I was saying, and then keep 2 of them to run for the rest of the day.
Come September, but but I think raising new wages is a good thing. We shouldn't complain about it.
John, thank you very much. Thanks for joining us. So John Sepek, author of the Money Distilled newsletter. You can get that delivered to your inbox. Coming up on the programme, we'll get back to US politics. Former President Donald Trump is indicted in Atlanta over his efforts to undo his defeat in the 2020 election. In the state of Georgia, we get the details next. This is Bloomberg.
We struggle here as this is 76.8% of the last swing, and our box from the market structure that was created yesterday before the run up. Okay, look like the YM. It was a huge oversold. We found the temporary support
This
here.
markets today, we are 41, almost 42 minutes into the trading day. You are seeing losses across the European benchmark of 0.6%. The FTSE 100 is getting a bloody nose, down 1% on the back stronger wage data. And market bets that BOE may need to go to 6% from 5.25%. What that means, of course, for the broader UK economy. From the UK, though, to the politics and the alleged wrongdoing of Donald Trump stateside. The former president has been indicted in Atlanta over alleged efforts to undo his 2020 election defeat in Georgia. It adds another criminal case against the former president as he campaigns, of course, for the White House. Trump's lawyers called the indictment flawed and unconstitutional. For the details, let's bring in Bloomberg's Bruce Einhorn. Bruce, what are the details around this latest indictment? How much of a surprise is it, and what does it mean for Trump?
Well, the indictment itself is not a surprise. This is an investigation that's been going on for several years now, and most people were expecting this indictment was going to come down now. What is surprising is just the number of people involved. So 19 people indicted, including the former president, as well as Rudy Giuliani, the former New York City mayor, who's the Trump lawyer, as well as several other Trump lawyers. One name that is somewhat surprising because he wasn't in the indictment that we recently saw from Special Counsel Jack Smith involving the January 6th case was Mark Meadows, the chief of staff to former President Trump during the end of his term. He was indicted along with the others. There were 30 people referred to as unindicted co-conspirators in this case. All told, 41 different counts including racketeering, making false statements, conspiracy to commit forgery, file for false documents, election fraud, computer theft, influencing witnesses. Just to give you a sense of how potentially serious all this is for the former president and the others indicted here, racketeering alone has a minimum of a 5-year prison term. It could go up to 20 years. The district attorney, Fani Willis, has said that she expects all the 19 people indicted to surrender by August 25th. She intends on asking for a speedy trial within 6 months. Of course, that's not something that is up to her. That will be up to whoever the judge is on this case.
Okay, and Trump, of course, trying to get on the campaign trail while all of this is happening. Bruce, set this in the context of the forthcoming election for us.
The former president has a full calendar when it comes to legal court appearances. So this is the 4th criminal indictment that he has. There are also several civil cases that are going to be going to trial in the next few months. When this will fit in with the others, that is a big question. One thing to keep in mind, as opposed to some of the other cases, one filed by Special Counsel Jack Smith,
below the support, you are above it, below the
Fani
200.
Willis is a district attorney in the state of Georgia. This is a state charge, not a federal charge. So former President Trump is running for re-election. If he were to win, he potentially could issue pardons to those convicted, as well as to himself in federal cases. That's not the case in a state case. So if he were convicted in Georgia and if he were reelected, he would not be in a position to pardon himself. So this puts this case in a very different category than the Department of Justice case.
That's an interesting detail. He can't pardon himself in Georgia if he was considering trying to go down that route. What do we know about the realities, though, of any of these cases actually completing, ending with decisions before?
My stop loss is just a little bit above the trailing stop.
So the former president is clearly doing very well among Republican voters. The indictments have not hurt him there. And there is nothing in the U.S. Constitution that forbids anyone from.
I got only last contract left. All of the TP was done.
So the question, though, is how many of these trials could actually get done between now and November? That is really unclear. So the Mar-a-Lago case, for instance, the one involving the classified documents, that's a very complicated case with a lot of issues regarding security clearance. So the Department of Justice has asked for a speedy trial.
Probably I will stay till 9 a.m. my London time, and then I'll just close it with the runners to run. Come back
New York City District Attorney Alvin Bragg
before
has a case
an hour before
the former president's alleged payments of hush
New
money
York
to a adult film star. That trial was supposed to be in May. Alvin Bragg has said he'd be willing to move that trial and let the January 6th trial involving Jack Smith, the special counsel Jack Smith, potentially allow that one to go first. Where the Georgia case fits in with all this, that's a good question. And we don't have any answers at the moment. The next day here will be the end of the month when the district attorney has said that she expects everyone to surrender. Then we'll start finding out more about the judge in the case and when the
so far we can see our new algo indicator has done quite a nice job.
We'll be trying to continue to
Most of the time the line stay red.
Bruce Einhorn, the latest on US politics and former President Trump. Coming up on the program,
With very small pullbacks, it was expected to see some kind of the movement on the London Open.
This is Big Tech.
You can see those quite over, so that this area, if you're not a scalper, soon as we stop printing the square there, I will expect the price to start a small retracement. Okay, try to go a bit higher.
We must abide by the truth, which is what I mean by pragmatism. It is that Taiwan is already a sovereign, independent country called the Republic of China. It's not part of the People's Republic of China. The ROC and PRC are not subordinate to one another. It is not necessary to declare independence.
What is your roadmap to formal independence?
因为我的责任就是维持台海的现状。My responsibility is to maintain the status quo in the Taiwan Strait while protecting Taiwan and maintaining democracy, peace, and prosperity. So no such framework exists. We must work to maintain the peaceful status quo because Taiwan is already a sovereign country.
How confident are you that the U.S. will have Taiwan's back should the situation with China escalate?
美国是台湾的好朋友。The US is a close friend of Taiwan. We are partners in a number of areas, from politics, the economy, human rights, to our society. 因为台湾的安全问题 Because Taiwan's security challenges are a global concern, the upkeep of peace and stability in both the Taiwan Strait and the Indo-Pacific region fulfills the common interests of the international community. I believe that all democracies in the world, including the US, would be aware of how to respond
Okay,
if such
this is
scenario
testing
were
very
to take
expensive
place.
area.
What do you want the world to know about you as a person?
我是一个理性
Dollar
I am a
wanna go
rational and steady
higher.
leader. I know how we can respond to the challenges we face as a country.
As I marked a few
I
days
also
ago,
understand that the
there's the
serious
area
and
which
complex
dollar
nature of issues in the
shouldn't
Taiwan
cross.
Strait call for rational and steady leadership. This will enable our country to move forward amid changing geopolitical circumstances.
That was the Taiwanese Vice President Lai Ching-te speaking exclusively to Bloomberg Businessweek's Joel Weber. Now, China's central bank has unexpectedly cut a key interest rate by the most since 2020 in a move aimed at bolstering the country's faltering recovery. It came shortly before the release of pretty disappointing economic data.
Oil
Once
going
again,
nice for
data
lower.
that missed estimates. Let's bring in Sophia Costa now from our Markets Today team. Sophia, for you, which data point really stands out as we look at the pay
and
process?
you're going towards my GP.
And also private investment. I mean, if you look at retail sales, let's not forget that expectations were pretty low. So the fact that data missed these expectations, which have been really driven to the ground,
12 points
is
away
really
from it.
is not great for confidence. If you look at retail sales and strip out food and beverages, so essential spending, if you look at just discretionary spending, that actually fell month on month. It really shows how weak the consumer is. That will be worrying Beijing. Private sector investment, given the pro-business stance that the new government is pushing, really kind of saying, hey, we're open for business. We really want to revive confidence. Official meeting with big tech CEOs. That's really supposed to be the thing that shows confidence. But investment still fell. So households are not spending, businesses are not investing. That's like none of the stimulus that China has done, either when it comes to speaking or actually delivering more liquidity into the financial system. That's not coming through.
And rate cuts that we've seen in the past haven't turned that story around that you described there, Sophia. So do we think that the rate cuts we've heard about this morning make a difference?
I think there's a problem here because the PBOC's hands are tied. There's not much else they can do. They're not going to inject more liquidity into the financial system because credit data last week showed that there isn't demand for this. Like no one really wants more loans when you don't have confidence in the future, because what are you going to use that money for? The fact that the PBOC cut interest rates, I think it's more of a signaling thing today. They were criticized for not doing more. It came a lot earlier than expected. It's a much bigger cut than expected. But at the end of the day, if confidence is this low, making loans cheaper when they're already this cheap is not going to really help. I do think they have to do something, given what we've seen in recent days with property developers, country are almost on the brink of defaulting, and also what we saw with the trust industry. It was an important move to signal to the market that they're doing something, and also signaling also to the stock markets that they're cutting stamp duty. So market confidence boosting, it didn't work. So yeah, much more work needed to be done here.
More work, and we'll see if we get any further headlines around stamp duty and the rate of that, because that was a headline that dropped later in the day, wasn't it? But still in trading hours, interesting to see if that does anything to change the story. Sophia, thank you very much. Sophia Costa from our Markets Today team. And Tom, in terms of the UK story, we must return to that because the FTSE 100 really outperformed. We saw a pop in the pound as a result of rising expectations of rates, but that's come off a little bit, 126.98.
Yeah, across your major indexes, is the FTSE 100 posting the biggest losses right now, down 1.1% at 7,424. You talk about the pound, currently at 126.97. The movement really, the action very much in the front end as well as in equities, and in the front end gilt, the 2-year at 516. That was a move higher by 8 basis points as markets start to price in potentially 6% from the BOE. That is it for Markets Today. You can keep across all these market action, of course, by staying tuned to Bloomberg TV and going to the website. Stay with us. This is Bloomberg.
Okay, 3 more minutes and I will go for a break. Kamalenko.
Newsmakers and market movers.
3 points away from the TP. Can you give it to me and I can just leave that on a run, or should I close that?
And here's what's coming up on today's program.
That one manually.
By the most since 2020, the move came shortly before a batch of disappointing data, including retail sales. Donald Trump and some of his top administration officials are indicted in the state of Georgia over efforts to overturn the 2020 presidential election. It's the
Going
fourth
very
case against
nice
Trump
and
as he
down.
campaigns to return to the
The
White House.
last
And
contract
UK wage growth actually accelerates to the strongest pace on record, lifting the pound
and the
adding to
gold
inflationary
trade
concerns.
is
So we have a
lower.
great lineup of exclusive interviews coming up. But first thing is first, let's check on the European market map. But as you know, a lot of this, what's happening in Europe, will be dictated by not only the Fed, but of course by the Bank of England. We're seeing a little bit of downward pressure. It's also the August 15th, which means that a lot of places in Europe on our holiday, in Italy, it's Ferragosto. So happy Ferragosto to those that celebrate the DAX, down 0.7%. Now, as we were saying, UK wage growth actually accelerated more than expected. In fact, it's the strongest pace on record. Now, what this means is that it really underscores the Bank of England's concern that it hasn't broken this wage price spiral feeding inflation across the economy. This is the picture for the moment for sterling. If we see what it's doing today, of course, the Bank of England worrying that soaring pay is pushing up prices across the economy. And in terms of the pound extending gains after the release, as again, traders are now trying to weigh up whether the BOE needs to do a lot more. Look, Japan's currency intervention also dropped to a level that triggered the first yen buying intervention since 1999 in September, currently 145.86. So we're still on yen watch. The comments from the finance minister caused the yen to rise a bit. The currency overall has depreciated some 3% since the Bank of Japan decided to tolerate a higher benchmark bond yield, and that was around June 28th. So you see the move there from that moment, 145.86 is where we're now. And then the third story on currency markets, but overall it's really this China data that's weaker than expected, which prompted policymakers to do a little bit more. Now, we have some strategists, including our Mark Cranfield, saying that the yuan has now become collateral damage in China's quest to improve sentiment towards its asset markets. So we're seeing some of the daily reference rates versus Fiat Smiths. We also look at the Chinese government bond yield dropping to a three-year low. And of course, if you look at what investors are now trying to figure out, if
I need a bit of the time here.
markets, currency, or certainly policymakers, is out for itself. Now, China's central bank has unexpectedly, as we were just saying, in fact, on one, cut a key interest rate by the most since 2020 in a move aimed at bolstering
Okay, guys, see you tomorrow. I'll close the stream for now.
the release of disappointing economic activity data for July. That is estimates joining us now is Beata Manthey, head of European equity
I'm back
strategy
for
at
the US
Citigroup's
session,
Global
but will be
Markets.
only
Beata,
in a group
great to
chat.
see you.